Hello, welcome European listeners and market participants, and welcome to KBRA's latest Conversation in European Credit podcast. I am Gordon Kerr, Head of European Research at KBRA, and today I'm joined by my colleagues Garret Tynan and Karim Nassif from the European Project Finance Ratings team. In this episode, we'll be discussing the outlook for project finance and infrastructure finance in 2022, covering the content of the recently published report, Project Finance and Infrastructure, European and UK 2022 Outlook. The report and related information can be found on kbra.com. The outlook for European and UK project finance and infrastructure sector is, broadly speaking, relatively positive, with a large focus on renewable energy finance, both traditional and newer technologies, telecommunications, accommodation infrastructure, and transport esoteric asset classes. In this podcast, we will examine certain emerging themes likely to take center stage in 2022. The rollout of transactions in new project finance and infrastructure sectors is attracting plenty of private placement and capital market interest, particularly within Europe, where there is a big push and a great deal of funding dedicated to growing renewable infrastructure and technologies in the near term. Their development will face challenges, including not currently reaching the scale demanded by market participants, as well as the risks to dramatic movements to the underlying markets in terms of price and volume. And of course, the risk of obsolescence for some of the newer sectors. And starting with Garret, how do you view the development of the market in Europe and the overarching themes project finance and infrastructure market is likely to face in 2022?
Thank you, Gordon. I think you've set the scene quite nicely insofar that I think we're going to continue to see ongoing activity in sectors such as telecoms, for example, fiber, towers, and increasingly probably data centers. I also expect that there will be a continued focus on renewable transactions, especially given the scale of investment needed to facilitate the energy transition. The investment required is simply enormous. And perhaps also, as you alluded to, we'll start seeing deals involving emerging technologies such as energy storage and hydrogen. Maybe not so much this year, but certainly, as we move into next year, we expect to hear more about these particular subsectors of the energy world. Then, as you mentioned, we've also got some more traditional transactions like transport and accommodation. And this is all against a backdrop of increasing inflationary pressures and risk of interest rate hikes. So I'm told I think we're set for an interesting year.
Thank you. Karim, maybe you can give us a better understanding in terms of the challenges for some of the newer project finance sectors and how there may be some new structures that might evolve into tackling these problems.
Thank you, Gordon. Yeah, I think the newer sectors' challenges can be sort of broken down into three parts. Partly, it's what Garret was referring to earlier. It's the deal sizes. Some of these transactions are coming into the bank market initially because they involve asset financings that are increasingly bespoke, whether it's on the fiber side or standalone new energy asset classes. They're not large enough yet to attract necessarily capital markets, but they are in and of themselves starting to get traction in the bank market. In terms of market risk, would be the other major topic, and obsolescence risk is the other one. Market risk is a very interesting one because we are, as Garret alluded to earlier, we are seeing battery storage transactions, for example, being discussed increasingly, hydrogen, EV charging. The key question with a lot of these transactions, for example, is when they're part of a hybrid solution involving a traditional asset class where investors are comfortable with the operational and technology risk, and they're a small part of the financing, it's generally been easier for the investors and the lenders to get comfortable. But if these emerging asset classes are to fund themselves on a bespoke basis, question marks are going to emerge around merchant risk, particularly if in the absence of offtake contracts with creditworthy counterparties. The questions around market risk will increasingly come up, and the question around how to get comfortable with the underlying credit quality in the absence of these contracts. We see this phenomenon emerge in the traditional renewable asset classes, wind and solar, where more market risk is coming in. But the difference there is there's a longer track record for investors. Then you have the obsolescence risk, which is basically not present with the traditional renewable sources. So when we look at wind and solar, we don't have an issue in terms of the asset life because the wind is going to continue to blow and the sun will continue to shine. These newer asset classes have degradation risk. Potentially, they have asset replacement risk. And, who's going to bear that cost? How will that be funded? And how will investors get comfortable with that particular risk over time? Especially also that technology is changing, and there may also be a requirement to replace assets over the life of the tenor of the financing to satisfy perhaps regulatory changes. In terms of the potential structures that are emerging, what I would say is we still see a lot of the holdco-opco structures being very popular to fund acquisitions by new owners or to support opco expansion. The interesting new development that we are seeing in transactions is the role of the insurance companies. They are obviously the old role of the monolines in public-private partnerships, PFIs in the UK. That's gone away, but largely. But what the insurance companies are doing now is they're providing sometimes some support to mitigate some of this market risk that we were describing earlier. Perhaps providing support for the floor price and on some transactions, as well as providing other means of support in terms of the evolving merchant risk that these transactions are exposed to. So indirect contingent support from insurance companies is something to also watch potentially going forward.
Thanks, Karim. Also worth noting that we did put out a report towards the end of last year covering that market and merchant risk angle and the evolving structures that are emerging in order to tackle those challenges. Going back to Garret. Garret, earlier you mentioned the impact of rising inflation and the potential for interest rate rises, as well as, of course, we are still not through the COVID-19 impact and the effect that could have. Maybe you can take us through some of the challenges that are faced in the project finance world with regards to those factors.
Certainly. I mean, I guess a period of sustained high inflation will present challenges. I think my sense, at least, is that there's a general assumption out there that inflationary price increases can simply be passed on to consumers. And while that's, I think, true for essential services in a low inflationary environment, I think that assumption will be put to the test when through a sort of a more extended period of high inflation, such as we're starting to see now, I suspect. This is given the fact that consumers simply have limited capacity to absorb cost increases. They'll have to make increasingly more difficult choices about how to spend their limited funds. So it's also going to be interesting to see if and where indeed governments or regulators will take steps to limit the ability to pass on such inflationary price increases. So I think that's a space we'll be watching with interest over the course of the next 6, 12, 18 months. With respect to interest rates, certainly we see a greater risk of rate hikes, and this is obviously linked to the inflationary environment, and it's certainly something we need to pay attention to, particularly with respect to refinancing risks and so forth. But our general approach, even before now, has been to sort of assess refinancing risk, sort of using baked-in high interest rates regardless. So it doesn't mean any change for our approach generally, I would say. In terms of COVID, the impact that has had, I mean, I think when lockdowns were initially imposed back in early 2020, we saw general passenger levels fall rapidly, as I think everyone experienced. The pace of recovery seems to be mixed. I think road transport has been very quick to recover. We've seen traffic levels bounce back, in some cases even above 2019 levels. Airports and rail are probably taking a bit longer. Airports in particular, I think, difficult to be precise, but I suspect we're going to see something of a bounce back this year, building on for a recovery seen last year, with then sort of a gradual return to 2019 levels, probably by, and this is only my guess, 2024, 25.
Thank you very much, Garret. Karim, what about some of the other sectors that might feel the impact of inflation or interest rate rises or even potentially impact of COVID-19? Are there any other sort of things that stand out for you?
And I think the energy space is an interesting one to watch because there's a couple of dynamics going on. There's the outside factors that are sort of outside of the control of entities, that the impact, for example, on the commodity price and the geopolitical environment. And then there's the question of what are they doing about it to the extent that they can. For example, when we look at some of our suppliers, some of the suppliers that we rate, we can see that increasingly they're looking at hedging strategies, especially in countries where they're importing the fuel. They need to have that certainty of cost. And hedging is becoming very popular to the extent that it's available. And it's not always available. And it's going to be interesting to see to what extent liquidity is available to continue to hedge. But that is a big element that suppliers can try to do, taking into account Garrett's point about, there's going to be some pressure on the ability to pass on those costs to final consumers, noting the socioeconomic implications of trying to do that across the board. We've seen France, for example, place a ceiling on electricity price rises for consumers in from March 2022. Then there's the impact of some regulatory regimes have a formula that compensates the generator based on the regulator's view of how prices are going to evolve. Well, the prices today are very high. So if that is the assumption made by the regulator, how will that generator be, faring going forward? There's also the question of supplies and supply bottlenecks. And, we've seen solar panel costs go up very high. Other equipment will potentially face issues in terms of price hikes. So how are the transactions protected from a sort of inventory supply, availability, reserve, on-site perspective? Those companies that are well prepared, that have sufficient inventory, that can move quickly to replace parts, will fare better than others that are more exposed. So I think those are some of the dynamics that will be interesting to watch as well.
Great. Thank you very much, Karim. So just, I guess, to finally wrap up, Garret, is there anything else that you really see in terms of challenges facing or positives in the year to come?
I think it's going to be an interesting year. Many investors continue to seek stable returns in volatile times. So I would expect to see continued appetite for infrastructure type assets, particularly those linked to the energy transition or communications. It's, as we've already covered slightly, it's going to be particularly interesting to see how the market will approach newer subsectors such as hydrogen and energy storage. And just more broadly, the geopolitical environment obviously has the capacity to throw up surprises. So I think we'll be watching that with interest as the year passes.
Great. Thank you very much. So I guess in summary, we have a very interesting year to look forward to in project finance and infrastructure. Thank you very much for listening. We look forward to bringing you more conversations in European credit. Don't forget to check KBRA.com for our latest ratings and research. And we wish you all a prosperous 2022. Stay safe, and we will speak to you again soon.